This audio was brought to you by Business Radio, powered by Wharton, originally airing on SiriusXM.
You're listening to Your Money on Business Radio, powered by the Wharton School. Here again is Professor Kent Smetters.
Hello and welcome back. Kent Smetters, professor here at the Wharton School. You're listening to Your Money Business Radio, SiriusXM 132. Where that's the show. You know my routine. You're going to have a financial planner with me, taking your calls about your own financial situation. So if you want to know what to do with your money, how to save it, invest it, maybe providing for your kids, your retirement, grandma just left you a bunch of money, or just figuring out what to do with some real estate or budgeting, just give me a call. Live on Tuesday. So give me the call right now at 1-844-WHARTON. That's 1-844-942-7866. With me in this studio is Tom Meyer, is the CEO of Meyer Capital Group, a local town, Marlton, New Jersey. He's running the firm that his grandfather founded in 1967, and he was one of the early fee-only fiduciaries, truly a pioneer in the field, like all our advisors. Tom is a fee only. So, Tom, we've had you on the show many times, so thanks so much for coming back. Just remind us a little bit about your firm. If you have a typical client, what's he or she like?
So, Ken, first of all, thanks again for having me in here. I love coming in here, especially when it's not raining for once.
Yes.
So we're a money management firm. We are, as you said, fee-only, fiduciary, and we handle monies for families and businesses and foundations. We do comprehensive financial planning, and we basically do life planning. Excellent. We help people attain their financial goals.
Excellent. And again, speaking of Tom Meyer, who's the financial advisor and the CEO of Meyer Capital Group. Again, give us a call. I'd love to answer your questions with Tom here at 1-844-WHARTON. That's 1-844-942-7866. Let me go to Jose calling from California. How can I help you, Jose?
Yeah, hi. So I've got a kind of interesting situation. My wife and I both have, we're government employees. We have, pensions that are lined up, to pay off well, hopefully. But we have a rental, and that rental has accumulated quite a bit of equity at this point.
Yeah.
So the problem, though, is that the housing is at the peak of its market right now where I live in Central Coast of California. And so the question is, could I use that equity? I have about $300,000 to $350,000 in equity in that home to build maybe some apartments, or what can I do with all that equity if I feel that the housing market might be topping out where we're at?
Yeah, and let me ask you, you said that you have pensions. Are these state pensions or are these federal pensions?
These are state pensions.
Yeah. Do keep in mind, state-based pensions, are not backed by the Pension Benefit Guaranty Corporation. And California may get lucky, but California has some really serious issues with their state and local pensions. So just keep that in mind. We don't want to rely on that too much. So don't get me wrong, California might get lucky with the tech boom and other tax-based broadeners that pay for those pensions, but do keep put some haircut on those pensions. So tell me, how old are you, Jose? How much have you saved up outside of these pensions for kind of retirement? And what's the problem with maybe someday just selling these properties for retirement? Why would you want to build kind of more in California?
Well, I'm 45 years old.
Mm-hmm.
I've been with my agency for 20 years.
Sure.
And I'm at a point now where that property, I just feel like I can build more wealth. I can use that money as more of a wealth platform, maybe build some apartments and create residual income.
Yeah, or you could lose it all, it's a very focused investment. One asset class, one, state is, California lost 25% of its value during the last financial crisis. And of course, it did come back, but you don't want to kind of rest on that. How much have you saved up for retirement outside of these, of your pensions, rental property, kind of something like a 403B or taxable brokerage account, IRAs, things like that?
Yeah, so we've got a 457, I think it's called, which is a deferred compensation plan.
Yep.
And I want to say I want to have somewhere about 180,000 on my own, about my wife, about another 140 on hers.
Okay, good.
So maybe another So another 320 in there somewhere in that kind of money.
Good, and certainly you want to think about how you invest that and so forth. So this rental property, it's producing income that's in excess of the mortgage and taxes and upkeep costs, all that type of stuff.
Yeah, I think I'm netting about a positive of about maybe $1,000 a month in addition, on top of what my expenses are.
Yeah.
In profit or rental income.
Yeah.
Not including my federal taxes, of course, and state taxes after that, but just on a monthly basis, I'm profiting about $1,000.
Sure, yeah. So just net of your property taxes, upkeep. Don't forget about the upkeep and your mortgage, about $1,000 a month. I mean, so good. I mean, and that could change over time depending on what happens with the California market and so forth. And so it's really, it sounds like you want to figure out how to take a loan against that and got to double down on real estate. So Tom, your thoughts?
Well, I've been down this road before. Jose, let me ask you this: have you ever built before?
Have I what?
Have you ever built before?
No, but that's a family business. So I've got lots of uncles and cousins that do this. And that's kind of what inspired me, because one of them just spent about $200,000 for a vacant lot, and he built 12 apartments on there. And with our rents in Central Coast of California, that represents about maybe $2,000 per unit, about $24,000 a month in income. So, that's just kind of...
Okay, so, and I have to tell you, only 20% of Californians can actually afford to buy a home. So the rental market, although it's had some severe dips, will be very, very strong, I think, because of the fact that it's probably the lowest percentage of citizens that can buy a house in that state, of any state for that matter. So the cash flow is $1,000 a month. You got $350,000 in equity. I assume you have a mortgage on this.
Yeah, I do have mortgage, but it's a few years left, yeah.
Okay. A few years left. All right. I have to tell you, if you have family involved in that, God bless you. If you got somebody that knows what the heck they're doing when it comes to building.
Yeah, I mean, it's certainly, Jose, I think it's great that you have family in that area. My concern about it is simply that you're placing a lot of kind of wealth in kind of the rental market. What I would be really focusing on is not trusting so much on where the pensions are going to be in California. You're not going to like to hear this, but my joke used to be Illinois was our Greece and California is our Spain, because if you look at how underfunded the pensions are in those states, they are substantially underfunded still. And again, California might get lucky. They've taken a lot of big bets on the stock market, but they were always incredibly underfunded. And you can't look at the official funding numbers because they use really crazy discount rates on their future liabilities that are assuming risk-free returns are astronomically large. So, what I would be doing, Jose, is really enjoying this rental income. I'd be pocketing that $1,000 a month and really trying to put that money into a taxable brokerage account, and just enjoy what you got. But then, that rental property, I would, use that equity at some point to augment your saving for retirement or other goals that you might have. But trying to take a loan against that, which is essentially what you're talking about, to try to build more, doubling down, I think it's just not going to be a great idea, especially if you already have a home in California. It's all the more focused risk that you're taking, both in a single asset class as well as a single geographic area as well. So it's always tempting during the heydays. But remember, land prices and things like that already incorporate all the potential. If there's easy money to be made in this, everybody and their sisters doing it, driving up those land prices. Those land prices already reflect that you could buy or reflect this potential. So there's not kind of a free lunch there. So unless you have the passion, you're willing to cash out into some of your own sweat equity of building and so forth, and that's kind of your actual occupation, I would really hesitate to actually do that as an investment. Thanks so much for calling, Jose. I really appreciate it. And again, speak with Tom with the Meyer Capital Group, the CEO there, and give us a call. Love to answer your questions here at 1-844-WHARTON. That's 1-844-942-7866. Let me go to Joel, also calling from California. How can we help you, Joel?
Yes, this has to do with the 401k. I'm retired, not using the 401k, but it's real heavy in one company stock. The company I retired from, I'm getting close to going to sell the bulk of it because I want to reduce that exposure.
Yeah.
My thought was to throw it into like a Vanguard total stock market and a Vanguard prime cap. But both of those stocks are doing quite well right now. And my question would be, if I go ahead and reduce that exposure so that one company stock, might I park it into like a money market or something withheld within Fidelity, say, where it's at, being managed?
Yeah.
Just wait to try to wait. I know it's not smart to time the market, but the way those stock prices are up right now, your thoughts?
Yeah. I mean, you really are already exposed to those high stock prices. You just have that exposure with just one stock. I mean, so let me ask you. You say you have a 401k. It's heavy in your own, I assume, previous company stock, and so you could rebalance inside your 401k, not worry about the capital gains associated with that, if I'm understanding the case correctly. And so then you're just trying to figure out what you should do with that. I mean, how much money are we talking about? How much in this particular 401k that you would want to rebalance? How money have you saved for retirement? And also, give me your age as well.
That's several million sitting in there, and I've got other funds outside of that that's sustain us, so I don't need it, the 401k.
You don't need it. Okay. So let me ask you, the funds that you're sitting outside, those are liquid funds, and how are those invested? In a taxable brokerage account, or what are they doing?
Taxable brokerage accounts, money markets, real estate.
Okay. Yep. And but you're pretty convinced that this is money that you're not going to need. So you have in the 401k. So your plan for this is more intergenerational. Is to give it away? What's your plan for it?
Yeah, I'll probably just leave it to the heirs.
We'll leave it to the heirs, okay? Because that has a big effect. Like if it was for your own consumption, then we'll be talking about asset location a bit more, because you could actually move all that 401k to a bond fund, and just make sure the stuff in your taxable brokerage account is much more stock allocated. But if it's if the goal is to leave this to your heirs, then we want to kind of think about what's the right asset allocation with them in mind. So, Tom, your thoughts?
Yeah. Well, first of all, you do have a scenario here with company stock and a 401k to actually not roll that over to an IRA, but to go ahead and transfer that outside of the IRA and only pay capital gains tax rather than ordinary income. But you would have to talk to HR about that. That is a little bit of a get out of jail free card that employees have when they have company stock and 401ks.
Yeah, that's a good point.
Now, I'm not sure where your 401k is. I'm not sure what kind of investments that they offer. But as Ken said, outside of maybe that potential stock scenario, I would probably look at, a Schwab or a Vanguard and sit there and set up a nice diversified income portfolio that would, or income and growth, I should say, that would be there for your legacy and for you to sleep at night.
Yeah.
The real question is what I had is I'm going to sell that company stock. Yeah. I'm going to buy like a Vanguard total stock market with half of it, and prime cap with the other, because I'm already in the prime cap. But my question is, might I sell that company stock and put it in, just park it for a while and to see if this market's going to cool down before I buy the total stock market or the prime cap?
But you kind of answered your own question, Joel. I mean, that we don't believe a market today. If we're going to give you that advice, certainly our advice would be very different for a lot of people. I mean, the fact of the matter is, if that were the right strategy, trillions of other dollars would be doing the same thing, and as a result of that, you would not have the market kind of gains. I just think, one has to be careful about, you really want to think in terms of what is the correct asset allocation and tax strategy, not trying to figure out if the market is, overheated or not. Because a lot of people, I'll tell you, in 2008, after the market dropped quite a bit, a lot of people, sat out the market in 2009 and missed a big appreciation. And then they thought thought, well, the market's overheated in 2009, we'll sit it out, and they keep losing out. And so just we don't try to bet against trillions of dollars in the market. I mean, we think the market's probably efficient when there's no reason for us to try to time the market. But here's what I would do is break it down, is that you always want to ask yourself, what's the goal for this? And if you're very confident that this is not going to be used for your own consumption or your spouse's consumption, this is going to be left to the kids, then you want to start to think about, first of all, what's the right asset allocation for them, and that's really them as younger people, and that would be something that's potentially much more stock market based, and something like the Vanguard Total Stock Market Fund, and also. But then you really want to sit down with a CPA to kind of go through your options for both federal and state, because there's various tax strategies. Tom mentioned one, and that is to maybe realize capital gains today on your company's stock as you adjust out. But also there might be another strategy, and that is when you pass away, your kids are going to get what's called step up a basis at death, and so a lot of the cost basis will appreciate automatically upon your demise, and this is still well below the state tax level. At the same time, if you're giving them something that's an inherited IRA, 401k, things like that, that's going to be a different situation there, because they're going to have to eventually take required minimum distributions out of this. And so what you're going to have to do is go through those options with a CPA to really figure that out, with the goal in mind that you are using this for your kids. If this were for your own consumption, then the strategy is very different. In that case, I would actually be talking about maybe you're worried about the stock market, where it's at. Well, there's a double twofer here, and that is, even though I don't like timing the market, I would tell you to probably put all this in the Vanguard Total Bond Fund, and because it's in your 401k, and then or at least roll it into an IRA. Maybe do the capital gains taxation today to avoid the RMDs later on, but still. Outside of that tax minimization strategy, still put it all in the Vanguard Total Bond Fund, and then have your stock exposure be in your taxable brokerage account, because that's going to be the most efficient from a tax planning perspective, to have the bonds in something that is going to be tax deferred, and then your taxable account be something like the Vanguard Total Stock Market Fund. So the strategy is really going to vary a lot based on your goal in this case. If it's for you, then Vanguard Total Bond Fund, and maybe before or after you realize the capital gains. But if it's for your legacy, then that's where you want to likely continue to have that in stocks, but simply more diversified, like the Vanguard Total Stock Market Fund. But do sit down with the CPA to figure out, should you be realizing, because this company's stock, realizing the capital gains today? Probably it's not a bad idea, versus trying to use the tax deferral or even base a step up at that. So thanks so much for calling, Joel. I really appreciate it. Again, speaking with Tom Meyer, CEO of Meyer Capital Group, doing a great job answering questions here. Just give us a call. Love to answer a question live on Tuesday. So don't wait for a second hour or here for only this hour. And give me a call here at 1-844-WHARTON. That's 1-844-942-7866. Let me go to Eli, calling from New Jersey. How can you help you, Eli?
Hi, I'm calling for my sister. She has a lump sum of money, like $70,000, that she has to do something with.
Yep.
And she has some student loans, about $50,000, which I think are federal. I think the loans vary from between 4% to 6%.
Yeah.
I think there are 3 separate loans.
Mm-hmm.
And she wants to know if she should invest some of that money, or she should pay off her student loan.
Yeah. So
I understand there's a risk-free return with paying off student loans,
right.
But I wanted to know if there's one of the loans is 4%, and I guess it's pretty low. Would you say that rule applies in that case? And theoretically speaking, if someone has a loan that's under 4%, would you say the same thing?
Sure.
To pay off the loan.
Let me ask you your sister's situation. Does she have a job? Does she have an emergency account? Tell me some more about her. How stable is her income? All that type of stuff.
So she's married. Her husband has a good, stable job. Combined income, I think, is around $200,000. Mm-hmm. They live in California, so they have a high cost of living.
Sure.
But they are saving, I think, 10% of their income and putting it towards their retirement.
Good. And do they have a decent emergency account just for in case something comes?
Yes, they do.
Okay. All right. So, Tom, with those facts, it really comes down to, you're trying to get a potentially nice risk-free rate. We're also assuming she's not going to be qualifying for debt forgiveness, doing charitable work, things like that. Or government,
right,
things
right.
like that. So it's really just about essentially an arbitrage between, trying to invest in the markets, taking on the risk versus a pretty, potentially high risk-free return.
Or you do a little bit of both. And I think you take the 6%er, get rid of that, start investing for the future. I'm thinking about, I was going to say a Roth, but they might be excluded, unfortunately. But I would definitely put something toward retirement. So I would look at the 6%ers and I would start to invest for the future, unless they already have investments, which we haven't hit. And I'm assuming there's no credit card debt?
Not that I know of.
Yeah.
Okay. That's where I would go. I would definitely start some type of you can just do an IRA and maybe an outside taxable account, and then take maybe 25 to 30,000 and pay off the bigger loans. And I think you're getting two for the price of one.
Yeah, and one way of getting there, Eli, is it's really kind of how we typically do things is, we want to rank those emergency funds first, and let's assume that they have, 3 to 6 months worth of kind of expenses set aside. They're, if a higher risk job, lean more towards 6%. Let's also assume that they have their, proper life insurance. I don't know if they have kids. Often life insurance is kind of overlooked, things like that. And then, the next step after that is really making sure that at least they're getting their matches inside their 401k accounts provided by their employer, things like that. And it sounds like they probably would be if they're putting at least $20,000 a year away. And I couldn't tell if she's working or if it's just her husband's working, but either way, it's probably they're getting that free match money. And after that point, definitely I would be putting the way to think about this. If you are investing in the marketplace, unless you for whatever reason have some really risk-free income such that you're not holding any bonds at all, you're probably better off getting that 6% risk-free return, and even working all the way down to even a 4%. If someone offered me today a 4% risk-free return, I might be going for that. So I don't think there's anything wrong with necessarily paying these off. But what I definitely do is, it sounds like she has $70,000 extra. She could pay off the $50,000 in debt, and then the other $20,000, like as Tom said, she could open up a taxable brokerage account. Why would she keep the 4%ers around? Assuming it's a fixed rate, it's somewhat of an inflation hedge, in case inflation ever goes up. But still, 4% risk-free return is not a bad return. If it's a variable rate, that's a bigger deal. But you said these are federal, probably fixed rate. But even at 4%, if she wants to just clear off the books, she can get rid of all this debt. She certainly is not going wrong with that. And then she has another $20,000 left over to open up a taxable brokerage account. But if she wanted to keep some of the 4% around a little bit, as long as she's clearing off the higher ones, then that wouldn't bother me so much either. But again, if it were me, I'd probably just clear the decks right here, because even a 4% risk-free return, given that she has the other bases like emergency life insurance and the match taken care of, that's what I would be doing. So thanks so much for calling, Eli. I really appreciate it. Again, speaking of Tom, Meyer of Meyer Capital Group, doing a great job answering your questions here at 1-844-WHARTON. That's 1-844-942-7866. And let me go to Doug calling from Illinois. How can we help you, Doug?
How you guys doing?
Good.
How are you?
Did you hear me talk about Illinois being our Greece, and so you decided to give me a call? Is that right, Doug?
I did. Luckily, I don't work for the state.
Good for you.
So I'm looking to figure out where to put money next. I mean, my wife and I both work. We make a nice living. We max out the 401ks. We have an emergency fund. There's no debt other than the mortgage. But I'm trying to figure out, okay, now where do we go next? I don't. I mean, I've got. The emergency fund sits there and makes 2% in a money market. But do I pay down some mortgage? Do I, where do I hit?
Yeah. So you said you're maxing out your 401k. You have really no debt except your mortgage, which I assume is a fixed rate return. What is your mortgage rate?
Just under 4%.
Okay. So, it's not necessarily wrong to pay that down a little bit faster, but what other assets? Do you have a taxable brokerage account at this point?
We do not. So everything is tied up in those 401ks.
401ks, but you're at the limit for those, it sounds like. So what's the next step?
Right.
So Tom, talk about, a lot of times people don't realize that taxable brokerage account sounds, well, it's taxable. Why would I do that? But they can actually be part of a good tax retirement strategy.
Yeah, well, we get this all the time, this question of mortgage. Think about it. If 10 years ago somebody said, hey, oh, by the way, Doug, is this 30 or 15? 15 year.
It's a 30. It's a 30.
And how much more time do you have?
A lot. We just bought it. We're 28 years left.
Okay. Plenty of time. So if somebody would have said, wow, I'm going to get you a 30-year paper at 3.9%, I mean, we never would have believed it. And right. But I can say that until I'm blue in the face and say, hey, you can start your investment funds as long as, this mortgage does not hinder your life. But sure. We do have clients that they just, hate debt. And it's all about making them comfortable. And I can say, hey, I would take advantage of that. Keep that 3.9. You can throw, maybe $300-400 extra every month to pay down a little bit. But I would definitely start a brokerage account on the side and start getting taxable investments going for you.
Yeah.
As long as you are comfortable with this mortgage that you have.
Yeah. Yeah.
No, we're comfortable there. We've set it up so that if one of us lost our job, the mortgage can still be paid.
Good.
Perfect.
Yeah, excellent.
Oh, my God.
Yeah, Doug, so when it comes to the taxable brokerage account, a lot of people don't realize it can be part of a long-term efficient, tax strategy. But you just have to be kind of smart on how you do it. And in particular, especially if you're really thinking about using this money mainly to augment your retirement, let's take that or some other type of goal down the road that way. What you do is you decide what is the entire asset allocation between stocks and bonds, higher risk versus lower risk that you're comfortable with. And you have that asset allocation not at the single account level, but across all your accounts. And so what the idea is, you open up that taxable brokerage account, you invest in something like that's very broad based, like a Vanguard Total Stock Market Fund, Schwab Fidelity, but a very broad based stock market fund. And if you don't feel comfortable taking that much stock market risk, overall your entire portfolio, that's cool. What you do is you reduce some of your stock market risk in your 401k accounts to offset it. And so now you're taking more bond investment in your 401k accounts. And that's going to be a pretty good tax strategy. It's called asset location, a pretty good tax strategy for the long term, because at Vanguard accounts or whatever is, that you're choosing here, it's not going to produce a lot of capital gains along the way. There will be some realizations, but not a lot along the way. But you're only going to be taxed when you actually realize the gains, but that's going to be a long time from now, presumably with this money. And meanwhile, those bonds are producing income along the way, but it's in your tax deferred account. So, that's good and tax efficient. So it's that combination of that taxable and tax deferred accounts that can really work together to give you a really kind of strong, a fairly tax efficient way for saving for retirement. People make too much about the contribution limits with their 401k. The fact of the matter is it's really easy to work within those contribution limits and still pack a pretty good punch toward retirement later on. Thanks so much for calling. I really appreciate it, Doug. And let me go to Marcia calling from Florida. How can we help you, Marcia?
Hi, thank you for taking my call. I love your show. I learned so much from it.
Thanks.
So my question is I have recently taken a buyout from my company, so I'm not continuing to contribute to my 401. I've been working for about 32 years. There's about about 600,000 in it now, and I've been, working with my financial planner. I've been very concerned about losing that. So I really encouraged him to not, to put it into very conservative areas, money markets, things like that. And he's always pushing me to put more into stocks, thinking that, I'll get a better return. I think, this year so far it's running around 5%. And others, I think, that have more of a mixture in the 10 to maybe 12% return, and I know that's very short-term view, but, is there any guideline of, what in a 401 with someone my age, really what I should be?
Yeah. How old are you? Remind me, how old are you again? It sounds like you have retired, and are you going to have Social Security income? What are
No, I took a buyout kind of early on, so I'm only 58, and we'll probably be doing something more on a part-time basis or consulting basis after this. So the, good income probably is going to continue coming, So, but I'm married and my husband has a pension, so, we're doing okay. I don't need to go into the 401, so I won't need to go into it, for a long time. So it's a matter of what should I do with it now, and just not to lose on it.
Yeah, and so
hopefully.
Sure, and so it sounds like the 600,000 is 401. I mean, do you have a sense of how big that pension is? How much that's going to produce every month in terms of income? What your expenses are per month?
My husband's pension is covering our expenses, and then when he starts taking Social Security, that'll be good too. So. We are doing, okay with the pension and paying our bills, and, we'll probably scale back where we need to continue that. Yeah. So, hopefully we won't have to tap into the 401.
So your concern with the stock market risk is you just don't want to lose, or do you actually have, concerns like out-of-pocket medical expenses or other things that you have spending needs that you really want to protect when you're retired?
Yeah, I guess we would need the 401 down the road for probably medical expenses and all that type of thing. Yeah.
Okay. So, Tom, your thoughts?
Marcia, did you roll this over? Is this still in the 401k?
Well, it's in Fidelity.
Oh,
okay.
So it's in, I guess, yeah. So the 401 is in Fidelity now.
I'm assuming a rollover.
Is it?
Yeah.
Okay.
I'm sorry.
Okay. All right. Yeah. I would like to say one thing right here. Mm-hmm. Forget about what the market's doing. Forget about what Uncle Joe does at Thanksgiving and talks about it. He's up 20 and 30%. Because this is about you. And that 5% being as conservative as you are is very good. Forget about all the noise around you, because you have to be comfortable with your asset allocation. So when you're getting talked into buying stock or whatever and you feel uncomfortable, your advisor should understand that your risk tolerance is not where he wants you or she wants you to be. So you have to reiterate that you are conservative. You can have a very nicely done asset allocation, as Ken talks about all the time. It could be Vanguard, it could be Schwab, or Fidelity, whatever the case may be. They offer very low-cost opportunities for conservative investors that aren't going to lose a bundle when this market does eventually go through a correction, and you'll be very happy.
Yeah, I certainly agree with that. I mean, Marcia, I would even say if you're getting 5%, just keep in mind that you are taking risk in that portfolio. It just happens that in the last few years we've been doing, fairly well. And so you still have some exposure there, but it sounds like you're comfortable at that level. And given that you have a fair amount of safe income, that's good through the pension, through the Social Security, so forth. So it sounds like what this is really money for paying for maybe long-term care, out of the pocket, out of medical expenses, and so forth. And it's great that you are planning for that. One of the biggest mistakes people make into retirement is that they greatly underestimate how much they're going to need in out-of-pocket medical expenses. And plus, where Medicare being greatly underfunded, you'll want to be protecting for that. So I would say, hold the course and really rein in the financial advisor and really ask him also the big major question, is he fee only? If he says he's fee-based, run and get yourself a fee-only advisor. You can find them on my website.
Don't look back.
Yeah, my website, kentonmoney.com or napfa.org. So thanks so much for calling, Marsha. I'm going to sneak one more in. Alan, this is only going to be about a minute and a half here. You got a quick question for me?
Yeah, thanks, Ken. Thanks for taking my call.
Sure.
I've listened to the show for a while, really enjoy it.
Great.
I have a question about venture capital investing. You haven't really talked about this. I fully max out my IRA, 401k, 403b, and 457, have about $9 million of investable assets.
Yeah.
And want to think about diversification into either venture capital or non-public markets, and wanted to know how you think about it, percentages and things like that.
Yeah. I mean, it's certainly, and I'll give Tom his chance to think about, mention this as well. I really don't think of it as a diversification because you'd really need to almost be in a VC fund or, exposed across tons of companies in order to deal with the risk factor in that. So if you're part of a VC fund that is taking, Sequoia or something like that, that's taking lots and lots of bets, but if you're just doing personal bets, just assume that you're going to likely lose that money and only enjoy potentially some big upside for legacy or something else like that. But it's a big gamble, so I don't really think of it as that. But, just assume you just have to be comfortable losing that money, and your reason for doing it is because you want to take a couple swings at the fence. I even do that myself, and maybe live a big legacy. Tom, your quickly.
Yeah, real quick. Look, I'll tell you what. With your assets, obviously it's basically a 5-year commitment. There's a lot of fees involved, but I will say one thing. There is a disruptor on the horizon that just announced that they may be entering into the private equity field, and the fees will be dirt cheap compared to what's out there. And the name of the firm is Vanguard.
Yeah.
So they're getting involved in private equity maybe in the next 6 to 9 months. Yeah,
no, it's interesting. And Alan, certainly you definitely have the risk capacity to take on some risk. I mean, you put 5% of your portfolio, 5% toward it. You could do a lot of early stage invest, but just, be comfortable that you'd probably lose the money, but if you want to take a swing and try to get a $50 million payday for your legacy or whatever that purpose is, nonprofit, whatever, and then go for it. Thanks so much for calling. I want to thank Tom for coming back on the show. You can find more about Tom and his work at MeyerCG.com. Again, MeyerCG.com, or just simply Google Tom Meyer. I think my other wonderful guest, Barbara Hemphill, and audio engineer Deion Simmons. I will see you next Tuesday.
For more guest interviews, check out our Wharton Business Radio Highlights podcast on iTunes and Google Play.